When will interest rates go down? This is something we've heard for a long time, a question from clients. You'll all be pleased now to see that as of August 2023, as we can see here from the Bank of England website, the base rate in the United Kingdom dropped from 5.25% down to 5% on the 1st of August 2024, after obviously being hiked throughout the pandemic, at the start of the pandemic, up to 5.25% on the 3rd of August 2023. So exactly 1 year on from the last increase has the UK government started to bring it down. Now, people will be asking this question for one of many reasons. If you have a defined benefit pension transfer and you've done any of your homework, you'll probably understand the inverse relationship between gilt rates and cash equivalent transfer values. Now, the Bank of England interest rate is not a gilt rate, but the Bank of England interest rate of 5% does affect the 20 and the 30-year gilt rates, and they is a main factor that DB schemes use to calculate when your cash equivalent transfer value. The second reason people might be asking is to do with savings. They're going to be thinking to themselves, hang on a minute, I've been having good level of savings growth with my bank, my high street deposits. I haven't had to take much equity risk at all. How long is that going to last for? And thirdly, in terms of mortgages, people are probably thinking, what's going to happen to my mortgage repayments? They've been so expensive recently. So to cover off those topics each in detail, number one, yes, if you're currently holding a defined benefit final salary pension scheme, if interest rates from the UK government are starting to drop, this should have an effect on the 20 and 30-year gilt rate. Those should drop. You can find those online as well if you Google them. You can even ask your schemes what gilt rate they use to complete your cash equivalent transfer value. That's what we do here at Cameron James when we're speaking with your schemes. That should in turn lead to an increase in your cash equivalent transfer value. So what we could say is, if the UK government is going to continue to drop the UK base rate, this should lead to a decrease in the 20 and 30-year gilt rate, which then should lead to an increase in the cash equivalent transfer value of your DB. However, nothing ever goes in a straight line like that. For all we know, the base rate could remain on hold where it is now at 5% for some period of time. If someone put a gun to my head and I had to guess, I would say I think the UK government will continue to keep dropping the base rate to get closer towards their inflationary measures of what they want. But also you just cannot have a stable economy with an interest rate of 5% from the government. So that kind of covers things from a DB perspective. But I would say it's extremely careful. When you're looking to get qualified and regulated authorized advice on your final salary pension pot, which here at Cameron James we work as part of a 2-advisor model, and you are introduced to the qualified and regulated pension transfer specialist, it's extremely important not to wait, in my professional opinion. If you require advice, go and get advice. Because I can tell you now from a PTS, pension transfer specialist perspective, the value of your CETV and what multiple you get does not form a large part of their discussion when they're talking about you potentially giving up a guaranteed income from life. It's much more about your situation, your needs, and your requirements. Also, on that side of things, I wouldn't say that it's a buyer's industry right now. Pension transfer specialists are getting absolutely squeezed left, right and centre in terms of their PI insurance cost to even keep operating as a firm. What I've seen in the industry is the number of PTSs is going like this. Even here at Cameron James, a number of PTSs that we've worked with over the past 12 to 24, 36 months have now exited the market because they're either focusing on something else or they simply don't think it's worth providing the advice anymore. So a lot of people in the comment section who are always saying to me, oh, everyone's in cahoots with each other, the FCA and financial advisors, everyone's making a racket out of this. If everyone's making such a racket out of this, why aren't people flooding to become pension transfer specialists? Why is it so difficult and why is it so expensive for them to continue operating? Secondly, in terms of interest rates. Now, a conversation I have very often with my clients recently is they say, well, I got this money over here. I'm earning, say, 4% or 5% from Barclays. I don't really see the point in taking any equity risk. I understand over the course of time, a balanced portfolio with, say, 65% equity may well have achieved returns of closer to 10% per annum. But I think I would rather stick with the safety net of just the capital risk or inter-party risk of holding it with a large bank in the UK. That conversation is going to start to change now because the rate that you're going to get from your Barclays, your Lloyds, your Santander, they're going to come down, as you probably would already seen. The Bank of England has took their rates down, so banks will start to take their rates down. And the question you have to ask yourself is, what is your cost of living in the UK? Is it going up or is it going down? Now, We can have general statistics of what the cost of living is in the UK if you believe those statistics in data. There's very many ways to manipulate that data by changing the inputs that you put into it for whatever particular political reasons. However, you have to think about yourself. Do you think your cost of living is getting more or less expensive? When you go out for dinner with your partner, when you drive your car, when you do anything in your life, when you go shopping, do you think things are getting more expensive or not? And at what rate do you think they're getting more expensive? So then you look at, for example, the example of, say, a 4% or 5% return from Barclays. Does that keep you in pace with the current cost of inflation in your life? For many clients, the answer will be no. For the average person, the answer will probably be no as well. So you have to look at it and say, what do you value more? Having your assets in a safe environment with low level of risk and having an XYZ level of return, or do you want to try to keep your pension assets or whatever assets liquid you have in line with inflation by getting growth, say closer to 6, 7, 8, 9, 10% return, depending upon your risk profile? Past performance is no guide to future performance, but equities have always outperformed cash over the long term. That's a fact, it's not my opinion. So that's something that you really need to consider. And lastly, mortgages. Yes, welcome relief. As I said earlier, if the UK base rate continues to drop, this should mean that obviously mortgages rates will continue to drop as well. Now, if you took a fixed term already, that's not going to affect you until the end. But if you took a tracker or something else, you will start to see the benefits of that quite quickly. I think it's also really interesting on mortgages. I mean, 3 or 4 years ago, there was many hysteria headlines, I should say, about how everyone was going to default on their mortgages, the UK property prices were going to crash, blah, 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 blah. I haven't seen that on the scale which it was talked and feared about. I think a lot of people have weathered the storms of their mortgages, obviously not everyone, but as a large economy, we've not seen that big dropout of people not being able to complete payments of their mortgages. I think people have just had to take money from other areas of their lives in order to continue seeing out their mortgage, as they probably thought UK base rate is going to drop in the near future. Guys, I hope you found that a useful video today. If you have any questions, let me know in the comment section below. And as always, take care with your UK pension assets.